Welcome back to the Deep Dive. It is Monday, February 9th, 2026. And today, we are going to look under the hood of the global economy. And I don't mean we're looking at interest rates or, inflation numbers or what the Fed is doing with basis points. We are looking at the plumbing, the invisible pipes that move money from point A to point B.
It's a fascinating topic because, well, when that plumbing works, nobody notices it. You swipe a card or you send a wire and life just goes on. But when it clogs, the whole system shudders. And right now, there's a massive clog in the system worth about $2.5 trillion.
$2.5 trillion. That is a number that is, it's just hard to wrap your head around. That's larger than the GDP of most countries on Earth.
Exactly. And that is the value of the global trade finance gap. It's money that businesses need to operate, to buy raw materials, to pay their workers, but they simply cannot access it. It is friction, pure economic friction.
I want to start with a scenario because I think a lot of people, they don't realize this happens every single day. Let's say you're a small business owner. You make, let's say specialized bolts for automotive engines. You're based in Pune, or maybe Vietnam, and you get a massive order from a huge car manufacturer in Detroit or Germany. It's the biggest order of your life. You are popping champagne.
You should be celebrating. I mean, that's the dream, right?
But then reality sets in. You read the contract. The car company says, great job. We love your bolts. Here is the purchase order. Ship them to us next month. And once we receive them and inspect them, we'll pay you in 90 days.
Ah, the classic working capital trap. It's what some people call the valley of death.
Right, because you have to buy the steel today. You have to pay your workers this Friday. You have to run the machines, pay for electricity, pay for the shipping. You have to float all those costs for 3, maybe even 4 months before you see a single dime of revenue.
And if you're a small business, you just don't have that kind of cash sitting in the bank. So logically, you go to a bank, you walk into your local branch, you slam that purchase order from that massive car company on the desk, and you say, look, I have guaranteed money coming in. Lend me the cash to build the product.
It seems like a complete no-brainer for the bank. It's a secured loan, basically.
It should be. It absolutely should be. But historically, the bank says no. Or they say, come back in 6 weeks when we've processed your paperwork. By which time you've lost the order.
Why? Why would a bank turn down what looks like easy money?
That is the multi-billion-dollar question, and the answer isn't that they hate small businesses. It's simple unit economics. It's what I call the Amazon ledger problem.
The Amazon ledger.
Yeah, just as an analogy. Imagine if Amazon had to manually handwrite a ledger entry, call a warehouse manager, and then physically inspect the shelf for every single toothbrush they sold. A toothbrush would cost you $500 just to cover the admin costs.
Right, of course.
Yeah.
It just doesn't scale.
And banks have had the same problem for decades. For a big bank like a Citi or an HDFC, processing a loan for, say, $50,000 used to cost almost as much in administrative overhead compliance, risk checks, manual data entry, as processing a loan for $50 million. So they just didn't do it. It was too expensive to lend to the small guys.
And that is exactly where our subject for today comes in. We are doing a deep dive into a company called Veefin Solutions.
Veefin Solutions. Now, if you haven't heard of them, don't worry. They are not a household name like Apple or Google. But in the world of banking software, they have become, well, something of a phenomenon.
They really have. And what's so interesting is that this isn't some 100-year-old institution. Veefin was incorporated in late 2020. We're talking about a company that is barely 6 years old as of today, in early 2026.
A pandemic baby, essentially, born right in the middle of a global crisis.
And the numbers they are putting up are just staggering. We're looking at revenue growth of over 200% recently. They have gone from being a tiny startup to a critical piece of infrastructure for banks globally.
And their mission is specifically to solve that valley of death we just talked about. They build the technology that allows banks to lend to those small businesses, the SME sector, quickly, efficiently, and without the mountain of paperwork.
So effectively, they're greasing the wheels of the global supply chain. They're the invisible engine behind the bank's ability to finally say yes to that small manufacturer.
Precisely. That's the perfect way to put it.
Okay, let's unpack this, because I think supply chain finance, or SCF, is one of those terms that just sounds incredibly boring. It sounds like something you sleep through in an MBA class. Yeah. But when you actually understand what it is, it's kind of magic.
It is magic. It's financial alchemy. It turns an invoice, a simple piece of paper, into liquid cash.
So how does Veefin actually do it? Because they aren't a bank. They're not lending their own money, are they?
Correct. And that is a crucial distinction. Veefin is a technology provider. They build the operating system for lending.
BOS, like Windows or iOS, but for loans.
Exactly that. Before a company like Veefin, a bank's lending department was this Frankenstein's monster of different software. They might have one system for onboarding. That's the digital application form where you upload your ID and documents. Then they'd have a totally different, unconnected system for underwriting. That's the math part, where they calculate if you can pay it back. And maybe a third system from another vendor for actually transferring the money.
And let me guess, none of these systems talk to each other.
Barely. I mean, you'd have bank employees literally printing a PDF from one system and then manually typing the numbers into another system. It was slow, it was error-prone, and it was incredibly expensive.
So Veefin comes along and says, throw all that out. Here's one unified platform that does everything.
Right. They offer an end-to-end stack: customer onboarding, smart credit decisioning, transaction management, and collections, all in one seamless flow.
And it's white labeled. I want to make sure the listeners really understand what that means, because it's why you might use Veefin without ever knowing it.
White labeling just means that Veefin sells the software to the bank, but the bank puts its own brand on it. So if you're that bolt manufacturer in Pune and you log into the state bank of wherever website to apply for your loan, the screen looks like the bank, the logo is the bank, but the engine running underneath, doing the math, checking the documents, moving the data, that's all Veefin.
They're the intel inside of the loan.
That's the one. And the reason this is winning in the market isn't just because it's unified. It's because of two specific technical innovations. It's their no-code configuration and this concept of deep-tier financing.
Okay, let's take those one by one. No code. I hear this term all the time in tech. Is it just a buzzword, or does it actually matter to a banker?
Oh, it matters immensely. And it all comes down to speed. In the old days, and by old days, I mean like 5 years ago, if a bank wanted to launch a new lending product, say working capital for textile exporters, it was a massive IT project.
You'd have to write a huge requirements document, hire developers, write all the code, test the code.
It would take 18 months, minimum. And by the time the product was actually ready, the market had completely changed. Veefin's platform is no code. And you can think of it like building with Lego blocks.
Okay, walk me through that. I'm a bank manager. I want to change a rule in our lending policy.
So you log into the Veefin admin panel. You don't see a single line of code. You see a dashboard with rules and workflows. Let's say you want to stop lending to companies with a credit score below 700. You literally find the block that says credit score, you type in 700, and you set the condition to reject if less than. You click save. It's live, instantly.
That's it. No calling the IT department. No filing a ticket and waiting 6 months.
No calling IT. No 6-month development cycle. You can launch a brand new product in weeks. You can tweak your risk model in minutes. For a bank trying to compete with all these nimble fintechs, that kind of agility is everything. It's a survival tool.
That really is a game changer. Okay, now what about this deep tier thing? That sounds like something out of a sci-fi movie.
It's really the next frontier of supply chain finance. So, okay, back to our car example. The big car company buys seats from a seat manufacturer. That seat manufacturer is the Tier 1 supplier. Banks have always been able to lend to Tier 1s because the car company can confirm the invoice. They'll say, yes, we owe the seat guy this much money.
Okay, that's easy. Straightforward.
But the seat guy buys his leather from a leather tannery. That's Tier 2. And the leather tannery buys its chemicals from a chemical plant. That's Tier 3.
And the bank has absolutely no idea who that chemical plant is. No visibility.
Exactly. They are invisible to the bank. They have no direct relationship with the big car company at the top. But they're the ones who are often the most desperate for cash. Veefin's platform is designed to handle this deep-tier financing.
How does it do that?
It digitizes the linkages in the chain. So if the car company approves the invoice for the seat guy and the seat guy, within the same system, approves the invoice for the leather guy, the system can trace that value chain all the way down. It allows the bank to lend to that Tier 3 supplier based on the creditworthiness of the giant car company at the top of the chain.
Wow, that just unlocks a massive amount of liquidity. We're talking about the smallest of the small guys who have never, ever had access to formal bank loans before.
It creates a powerful network effect. The deeper you go into the supply chain, the more sticky the product becomes for everyone involved.
So they've got the tech, they have the no-code speed, and the deep-tier reach. Let's look at the scoreboard. Does this actually work at scale? Because, Pretty software is useless if nobody uses it.
The scale is becoming, well, it's becoming undeniable. I want to hit you with a data point that really puts this in perspective. As of the FY24-25 data we have, Veefin had crossed a milestone of $25 billion in annual recurring revenue disbursements.
Wait, hold on. 25 billion. Is that Veefin's actual revenue?
No. Good clarification. If Veefin was making $25 billion in revenue, they'd be larger than Adobe. That is the total volume of financing loans, invoices processed through their platform annually.
Ah, got it. So
Yeah.
$25 billion worth of loans flowed through the pipes that Veefin built.
Exactly. But think about what that means for a second. That is $25 billion of real money moving to real businesses, all powered by their code. It proves the platform is robust, it's enterprise grade. It proves the banks trust it with critical high-stakes volume.
So they have the volume. Let's talk about how Veefin actually gets paid. Because if they aren't the ones lending the money, they can't be getting the interest payments.
Correct. They have a really smart hybrid model. First, there's the classic SaaS model, software as a service. The bank pays a subscription, a license fee just to use the software. That's nice, predictable, recurring revenue.
Keeps the lights on and pays the engineers.
Exactly. But the second stream is the kicker. It's the transaction fees. Veefin often takes a small cut, a revenue share of the financing volume that gets processed through the platform.
So they get paid to set up the shop, and then they get a cut of everything sold in the shop.
That's the ideal model, yes. And this is where the economics get really, really interesting. It's a concept called operating leverage.
Operating leverage. One of those finance terms that sounds dry, but is actually the holy grail for investors.
It really is. Think about a physical business like Ford. If Ford wants to sell twice as many cars, they basically have to build twice as many factories and buy twice as much steel. Their costs grow almost in lockstep with their revenue.
Right. It's a linear relationship.
Software is nonlinear. Once Veefin builds the platform, the code is written. Adding one more bank or processing another $1 billion in transactions costs Veefin almost nothing in terms of incremental effort. Their costs are mostly fixed engineers, servers, office space, but their revenue is variable. It grows with volume.
So every new dollar that comes in after they cover their fixed costs is mostly pure profit.
Exactly. And we can see this vividly in their recent numbers. This is incredible. In the first half of FY 2024-25, their revenue grew by 111%, which, I mean, that's huge growth on its own.
Yeah.
But their profits grew by 260%.
Whoa. So profits are growing more than twice as fast as revenue.
That is operating leverage in action. That's the textbook definition. When you scale a software business correctly, the bottom line just explodes upwards.
But wait, you can't build a $25 billion engine with 3 people in a garage. They must have a significant team. And talent costs money? A lot of money.
They do. Around the time of their IPO, they had about 370 employees. And here is a fascinating detail about their culture and their cost structure that you rarely see. Post-IPO, approximately 100 of those employees became crore patis.
Crore patis.
Yeah.
That's millionaires in local currency terms, right?
Okay,
A crore is 10 million rupees.
yes, exactly, because of the equity they held in the company.
That is incredible. 100 millionaires in a company of less than 400 people. That's
Yeah.
like nearly 30% of the entire company became rich.
It tells you two things. One, they are spending heavily on talent. Make no mistake, equity is a real cost to shareholders because it dilutes the stock. But two, and this is the crucial part, the alignment is incredibly strong. These employees aren't just punching a clock. They are owners. They are deeply personally incentivized to make this platform work.
That's a powerful retention tool. I mean, it's hard to poach an engineer who just made life-changing money and owns a piece of the rocket ship.
It's almost impossible. And in the tech world, retaining the people who built the code is often more important than the code itself.
Okay, speaking of rocket ships, let's get into the recent financial performance. We are sitting here in February 2026. We've got fresh data. What does the trajectory look like right now?
It's vertical.
Oh.
Not sure there's another word for it. Let's look at the baseline. In FY24, their revenue was around 25 crore.
Okay, 25 crores. So solid for a startup, but not, earth-shattering.
Right. Now, fast forward to the first 9 months of FY 2026. So that's the period that ended on December 31st, 2025. Their consolidated revenue hit somewhere in the range of 213 to 214 crore.
Wait, hold on. From 25 to over 210 in, What, basically less than 2 years?
Correct. We are looking at year-over-year growth rates that are consistently over 170%, sometimes hitting 200%. It's hyper-growth.
That is insane. How do you even manage that kind of scaling without the wheels completely falling off?
Well, that's the thing. It's messy. And that's what we need to talk about next. Because if you look closely at the numbers, and I know you have the report right there is a divergence between their standalone business and their consolidated business.
Okay, let's unpack that. Standalone versus consolidated. What's the difference?
Standalone is the core Veefin tech, the pure software business we've been describing. And that business is a cash machine. The EBITDA margins there are around 52%. The profit after tax, or PIT, margins are around 27%. That is world-class software profitability.
Okay, so the core engine is highly efficient. For every dollar of revenue they bring in, they keep 27 cents in profit. That's like Google-level profitability.
It is, but then you look at the consolidated numbers, which includes all the companies they've acquired or merged with recently. The margins there drop significantly. EBITDA is around 19%, and PAT is down to about 7 or 8%.
Whoa, whoa. That is a massive drop. Why? Are they just buying bad businesses? Why would you dilute that beautiful 27% margin with junk?
It's not junk, but it is different. They recently merged with or acquired companies like Veefin Solutions and GlobeTF Solutions. And these aren't pure SaaS plays. They are more service-heavy or integration-heavy.
And service-heavy means more people, more billable hours, which means lower margins. You just can't scale humans the way you can scale code.
Exactly. When you sell software, you sell the code once, a million times. When you sell services, you sell your time once. So by bringing these companies in, they have added a lot of revenue bulk, which helps explain that huge jump to 214 crore, but they have dragged down the average margin percentage.
So an investor just looking at the headline profit margin drops might panic. They might think the business model is breaking down.
They might. And to be clear, net margins have dropped from around 28% back in FY22 to around 11.7% recently.
So the natural question is the business getting worse? Or is this a deliberate strategic choice?
In my view, it's a very calculated land grab. They are consciously spending to grow. Look, selling enterprise software to a bank is hard. It takes a long, long time to get your foot in the door.
True, the sales cycles are brutal.
But if you buy a company that already has relationships with those banks, or you buy a company that provides the implementation services the bank needs to get set up, you grease the wheels. You remove the friction from the sale.
So they're sacrificing short-term efficiency for long-term market dominance. They're buying the distribution network.
Precisely. If you believe the market is going to be massive, you want to own as much of it as possible, as quickly as possible, before a competitor does. You worry about optimizing the margins later.
That makes a lot of sense. It's the classic Amazon strategy. Profits can wait, market share cannot.
Exactly. And speaking of grabbing land, let's talk about where this growth is actually coming from. Because it's not just an India story anymore. Not by a long shot.
Right. I saw that export number. By FY24, exports were already 45% of their revenue. That really surprised me. Usually, Indian fintechs focus on India first because the market here is just so huge. Why go global so early?
Because Veefin isn't targeting the US or Europe. They aren't trying to sell to JP Morgan in Manhattan. They are targeting the global south, Southeast Asia, the Middle East, Africa, and Latin America.
Why those specific regions? What's the common thread?
The common thread is that the problem they solve is most acute there. In the US, credit is relatively easy to get. The banking system is, well, it's pretty efficient. But in Vietnam, in Nigeria, in Brazil, you have the exact same dynamic as India. Fast-growing economies, rapid urbanization, and an SME sector that is absolutely starving for credit.
So that credit gap we talked about at the start is a global phenomenon in developing economies.
It is. And the banks in those regions are often technically behind. They might be running on legacy systems from the 1990s. They need a leapfrog solution.
Right.
Veefin comes in and says, here is a world-class, ready-made digital lending platform you can go live in a month. It's an incredibly compelling pitch.
It's like selling shovels in a gold rush, but the gold rush is happening in 20 different countries at the same time.
That's a great way to put it. But imagine the operational complexity. I mean, selling to a bank in Mumbai is one thing. Selling to a bank in Lagos or Jakarta. You've got different laws, different currencies, different languages, different compliance regimes.
It sounds like an operational nightmare. How does a team of less than, 400 people manage that?
They don't do it alone. And this is the key to their global strategy. Alliances.
Alliances.
They partner with system integrators and consultants. Basically, they get other people to sell their software for them.
Okay, explain how that works in practice.
Let's say a big consulting firm, like a local version of a Deloitte or an Accenture in Africa, is helping a Nigerian bank modernize its IT systems. The bank's CEO asks, "What should we use for supply chain finance?" The consultant recommends Veefin.
Ah, I see. So the consultant does the selling, the local integration, and the hand-holding. Veefin just provides the license and the core back-end technology.
Exactly. It allows them to leverage other people's sales teams and local expertise. It's how you scale your reach without bloating your own headcount.
And I read about something called the PSB Exchange here in India. That's another one of these partnership examples, right?
Yes, and a very important one. The PSB Exchange is a platform specifically designed for the public sector banks in India. It aggregates loan applications from multiple banks. It recently hit 4,000 crore in approved limits. That is a massive validation from the government sector, which is notoriously slow to adopt new technology.
So they're winning in the private sector, winning in the public sector, and winning globally. It sounds perfect, almost too perfect.
Just doesn't it?
And you know me. When things look this perfect, I get nervous. This is the deep dive, and we have to look at the risks. What keeps the CEO up at night? What could derail this speeding train?
There are three main buckets of risk here, I think. And the first one is the big one, regulatory risk.
The regulator. The eye of Sauron for any fintech.
Especially in finance. Veefin serves regulated entities banks. They live and die by the regulator's pen. Imagine if the RBI, the Reserve Bank of India, or a central bank in Indonesia suddenly says, "We are tightening the rules on digital lending. No more third-party platforms can handle customer data."
Or all financial data servers must be physically located within our country. Data localization. That's a common one.
Exactly.
Yeah.
That would be a potential disaster. It would freeze their clients. If the banks stop spending because they are afraid of the regulator, Veefin's revenue dries up instantly. We saw a bit of this with the digital lending guidelines in India a few years ago. The whole industry just hit the pause button for 6 months to figure out the new rules.
So they are, in a very real sense, at the mercy of government policy. That is a terrifying place for a high-growth company to be.
Always. You're effectively building a castle on someone else's land.
What's the second risk?
Competition. We talked about their moat, the first mover advantage, the high switching costs, but sharks smell blood in the water.
And who are the sharks in this space?
Well, you have the giants, Oracle, Infosys,
Yeah.
Tata Consultancy Services. These companies have virtually unlimited resources. They have tens of thousands of engineers. And critically, they have deep, decades-long relationships with the CEOs and CIOs of these very same banks.
So if Oracle decides, hey, the supply chain finance market looks tasty, let's build a module for it, they could just bundle it with their existing core banking software and try to crush Veefin.
They could try. Veefin's defense is that they are specialists. They are deeper, faster, and better at this specific niche. They'll argue a giant can't replicate their focus, but you should never, ever underestimate a giant with a bundle deal.
And what about the other fintechs? We hear about companies like Stripe or Square moving into lending. Are they a threat?
They are, but in a different way. It's interesting. Stripe and Square usually lend directly to merchants on their platforms. They bypass the bank entirely. Veefin is actually enabling the banks to fight back against them.
Ah, I see. It's the Empire Strikes Back.
Exactly. Banks realized they were losing their most profitable business to the fintechs. Veefin comes in and gives the banks the weapons, the technology to compete with the fintechs. So in a strange way, the rise of Stripe and Square actually helps Veefin because it scares the banks into buying Veefin's software.
Fear is a great motivator for sales.
The best there is. But there is a third risk, and it's a financial one. It's the return on equity, or ROE.
I noticed that in the notes. Their current ROE is pretty low, right? Something like 3 to 5%.
It is surprisingly low for a tech company this profitable. And listeners might look at that and say, wait a minute, why am I investing in a company returning 3% when a simple savings account in India pays 7%?
That is a very valid question.
Yeah.
If the core business is so profitable, where is the return for shareholders?
The answer lies in something called the J-curve. They raise a lot of money in their IPO and subsequent rounds. That inflated their equity base. That's the denominator in the ROE calculation. So they are sitting on a big pile of cash and assets that haven't fully started generating profits yet.
So they have a war chest that they either haven't spent effectively yet or the spending just hasn't paid off yet.
A bit of both. They are deploying that capital into those acquisitions we discussed and into expanding into new countries. It takes time for that investment money to turn into real recurring profit. Investors need to have patience. But if that J-curve doesn't turn upwards, if they spend all that money and the profits don't follow, then that low ROE becomes a permanent problem.
That is the ultimate danger of the land grab strategy, isn't it? You might grab a lot of land that turns out to be a swamp.
Exactly. Execution is everything. Integrating those acquired companies as Storify, GlobeTF is not easy. You have to mix cultures, merge tech stacks. That is where many great strategies fail, in the messy details of implementation.
So we've covered the tech, the money, the incredible growth, and the very real risks. Let's zoom out. What is this so what for the listener? Why should they care about a B2B software company like Veefin Solutions?
I think you have to contextualize the sheer size of the market. The global supply chain finance market for these tech platforms is estimated at roughly $50 to $60 billion in addressable revenue from transaction volume.
And Veefin is processing $25 billion.
No, be careful there. Veefin is processing $25 billion in loan volume, but the market potential, that $2.5 trillion gap we talked about at the start, is just, it's astronomical. India's SCF gap alone is estimated to be between $100 and $200 billion.
I see. So the $25 billion Veefin is processing is just a tiny drop in the bucket compared to the actual need out there.
Exactly. Veefin is a tiny fish in a massive, massive ocean. The headroom for growth is virtually unlimited if they can execute properly.
It's not like selling smartphones where everyone already has one. This is a greenfield opportunity. Most of this market is still running on paper and Excel spreadsheets.
It is, and there is a massive tailwind pushing them forward, the digital shift. Banks have to digitize. It is no longer optional. If a bank wants to survive the next decade, they cannot be running on paper and manual processes. Veefin is essentially selling oxygen to people who are suffocating.
That is a very strong position to be in.
It is. But we have to be realistic about the valuation. The stock has been incredibly volatile. We've seen a 52-week high of around 750 and a low of 256.
That is a roller coaster. That is not a stock for your grandmother's pension fund.
Not at all. It is a classic high-growth, high-expectation stock. You are paying for future execution, not just for current profits. If you buy into this story, you are betting that Veefin becomes the standard infrastructure, the default plumbing, for global trade finance.
You're betting on them becoming the Visa or MasterCard of B2B lending.
That is the bull case, yes.
So to wrap this all up, Veefin is rewiring the plumbing of global trade. They have explosive revenue growth. We're talking 200%. They have a sticky product. They have a massive addressable market. But they are navigating complex regulations and managing the inherent messiness of rapid scaling mergers, margin compression, and all the usual growing pains.
It's a high-stakes game. They are running very fast, and the ground beneath them is constantly shifting.
Before we go, I want to leave the listeners with a final thought. We've talked a lot about lending and software, but there is something else here, a hidden asset being built.
There is. You have to think about the data.
The data.
We talked about banks using Veefin to lend to suppliers, but to do that, Veefin's system has to see the invoices. It sees who is selling what to whom, for how much, and critically, when.
They see the flow of goods before the goods even move. They have a powerful leading indicator for the economy.
Exactly. They know that a car company in Detroit ordered steel from a plant in Pune 3 months before a single car is built. They have a real-time map of global supply and demand.
That data that's incredibly valuable.
It is. Government GDP data is always lagging. It tells you what happened last quarter. Veefin knows what is happening today. It's a technique called nowcasting.
If you aggregate that volume, if they get to $100 billion, $200 billion processed, they become a real-time macroeconomic barometer.
Precisely. So the final provocative question is this. Eventually, does Veefin just become the bank itself? Or do they become something even bigger? Do they become the world's most valuable trade data company? Imagine selling that anonymized data to hedge funds, to governments, to logistics companies.
The invisible layer that knows the price and flow of everything. That is, well, that's something to think about. A fascinating potential endgame.
It's a powerful position to be in. But let's bring it back to earth for just a second. To monetize that, they have to navigate a minefield of privacy laws, bank secrecy regulations, and most importantly, trust.
Right. You can't have a client wondering, hey, why did my biggest competitor know I was ordering less steel last month?
Exactly. If the banks think for 1 second that Veefin is selling their client data, the trust evaporates overnight. So while the potential is enormous, the execution of a data play is extremely delicate. They would have to anonymize it, aggregate it, and be incredibly careful.
A good point. Trust is the ultimate currency in banking. If you lose that, you have absolutely nothing.
Which brings us right back to the culture we mentioned earlier, those 100 corruptists. You need a team that is not just technically skilled, but is ethically aligned to manage that kind of power and that kind of sensitive information.
Well, on that note,
Yeah.
it's high risk, high reward. But I suppose that's what makes it a worthy deep dive.
Yeah, indeed.
We really are done this time. Thank you for sticking with us through the plumbing of the financial world. I promise you, the next time you see a Made in Vietnam or Made in India tag on a product, you'll think about that 90-day wait, and you'll think about the invisible software running in the background, making it all possible.
And keep an eye on those consolidated margins.
Always watch the margins. We'll see you next time on The Deep Dive.